Thank you for joining us today. This is part 4 in a part 4 series on the value of a CPA, an estate planning attorney, and a financial advisor throughout the different stages of life. For this webinar today, it's going to be geared toward individuals who may have aging parents and who are thinking about ways to help them prepare for maybe some physical or mental incapacity, planning for retirement, thinking about ways to transfer assets to the next generation. And today's webinar will be presented by Yuri Yu, Donna Lee, and Sophia Kim Sakamoto. Yuri is a certified public accountant and her office is located in Fullerton, California. Donna Lee is a certified financial planner and her office is located in the city of Orange. And me, I'm Sophia Kim Sakamoto. I'm an estate planning attorney, probate and living trusts, and our offices are in Buena Park and Mission Viejo. Next slide, please. So please, if you have any questions, type any questions in the chat box below. We will answer them at the end of the webinar, time permitting. Please note this webinar is being recorded. You should have had a pop-up when you entered the presentation. Just a short little disclaimer, of course, this is just general info. It's not going to create like an attorney-client relationship. If you do have a specific question, you should ask an attorney or financial advisor. And if you do, please don't take any screenshots or anything. If you do need to use that, please, we ask for written permission. Next slide.
Okay, so Donna, we'll get started. Donna, I'm sure a lot of what you do is helping people plan for retirement. So what is it about retirement that is such a turning point?
Saving for retirement is unique because while most goals are satisfied when you have saved a certain amount of money, doing that for retirement is just half the work. Now we have to make sure that you have saved enough to make sure it lasts you long enough. So therefore, retirement is seen as two distinct phases. The first phase is the accumulation phase, where you're actually saving for retirement. You're saving in the 401k and the IRAs, and you're watching your budget and saving towards retirement. And then that's the goal, right, is to have enough money for retirement. And then there's that turning point in which we change from the accumulation phase to the distribution phase. And here, now we're concerned about withdrawing from the account. So we want to make sure that the money lasts for your entire lifetime. The concept here is sequence of returns is a very important concept here. I think a lot of people are surprised by this. It makes sense when you learn about this in school, but sometimes we forget about it when it applies to actually our retirement accounts. So here, what I want to illustrate is there's two portfolios. I know there's a lot of words on this slide, so let me just break it down. There's person A and there's person B. They both start off with $500,000. What we're looking at is the sequence of returns. So in the year 2000, the S&P market did negative 9.1%. And then in 2001, it went down to negative 11.89. So we just listed someone, if they retired in the year 2000 and they started pulling, in this case, 25,000, 5%, 25,000 out every year for 17 years. At the end of 17 years, they have a balance of 183,000. Person B, on the other hand, same thing. They start off with $500,000 portfolio. They pull out 25,000 a year, just like person A, but here, for whatever reason, the returns were switched, okay? You can see that we just switched from 2016, 2015, 2014, it just flip-flops the returns. And after 17 years, the account balance is 582,000 after pulling out 25,000 every single year. So isn't it amazing to see the two people, they had started off with the exact same balance, right? They did the accumulation phase exactly the same. They got to the same point, pulled out exactly the same amount every year for 17 years, and yet they end up with drastically different numbers. And the only reason for that is just based off of luck. Somebody retired at a good time and those 17 years worked out, and somebody retired at an unlucky time and 17 years drained their money faster. So sequence of returns is really important. have to pay attention to when we're talking about the distribution phase. So this is a question that I get all the time between everyone, whether you're about to retire, whether you're just starting to save for retirement. It's how much do I actually need to retire? So you're going to get different answers when you look at different sources. But this exercise or this calculation kind of just walks you through what some advisors might do. So here's an example for someone that needs $100,000 a year gross income to live. So just to give you an idea, this is gross numbers. It translates into roughly a little over $60,000 after those darn taxes, federal and state. Okay, so for this client, they also receive about $25,000 a year in pension and Social Security. This is important to note because those are guaranteed payments that will come in every year. So therefore, there's just a gap that we have to make up, right? We only have to make up that $75,000 gap. Now, most traditional wealth management will use a safe withdrawal rate of somewhere between 3 to 4%. In my earlier example, you saw that when I used $25,000 a year pulling off of the account value, that's a 5% withdrawal rate. Person A was not looking very good, right? It may not last for their retirement. Most of us will spend 20 to 30 years in retirement these days. So running close to running through 80% of your account in 17 years is not going to cut it. So we'd rather be more conservative, especially as the market volatility increases. The safe withdrawal rate that you hear of advisors talking about will decrease. So right now, to be safe, I'm looking at 3.5% withdrawal rate. So if we're going to use a traditional wealth management calculation, if we're trying to come up with $75,000 a year, we'll need a lump sum of about $2 million, $2.14 million as a lump sum. We can safely withdraw, safely withdraw 3.5% every year, which will supplement that $25,000 that's coming in guaranteed from pension and Social Security. That extra $75,000, and that makes up my $100,000 I need. There's another option, and this is where financial advisors like to get creative, and we try to use the different tools at our disposal. So sometimes what I'll do is I will take a look at how much of that need is fixed expenses that you need for sure every single month, like a mortgage or health bills and such. So in this case, this single client, they need $100,000 a year, right? $25,000 of it comes from pension and security. We need to make up a gap of $75,000. Of the $75,000, let's just say $60,000 of that is fixed expenses. In this case, what I'll do is I'll use a combination of this traditional wealth management calculation and possibly other financial products. So there are products out there in the universe of financial products that can give us some type of a guarantee at say 5% a year. So if I do my calculation, if I can put $1.2 million in a lump sum, pull out 5% a year, guaranteed, that's my $60,000. That covers all my fixed expenses. The remaining $15,000 a year, I will use a traditional money management calculation, comes up with about 400 some thousand. Altogether, I only need 1.65 million. So what it does is by using different tools, we're able to bring down how much you actually need to save to retire at that same standard of living that you're looking at.
That's really interesting. I think that illustration really shows that how much you need to retire is different for every person, depending on what your fixed expenses are going to be and other things.
Yeah, and also the different tools that are available at the time that you retire.
So the common thought, I always thought that retirement age was 65 or, 55 if you're like really lucky. But Donna, when do you have to start taking retirement distributions?
So you actually don't have to start taking retirement distributions from your account, from your retirement account until age 72. Yuri, if you can go to the next slide. And maybe one more. So starting at age 72, the IRS will mandate you to withdraw a certain percentage every year from your pre-tax accounts. So remember, pre-tax accounts, that would include your IRAs, 401ks, 403bs, 457bs. Most retirements are pre-tax. But starting at age 72, the IRS will force you to take out a certain percentage each year. And if you don't, there will be a steep penalty. Now, just remember that this only applies to pre-tax accounts because the IRS is waiting to collect those taxes when you take them out. Makes sense? So if it's a post-tax account like a Roth IRA or a Roth 401k, doesn't really typically apply. Okay. These withdrawals are called RMDs, required minimum distributions. They used to start at age 70 and a half, but recently the passing of the Secure Act earlier this year, that was increased to age 72. So if you look at this slide here, this shows you a uniform lifetime table of how much you actually have to take out every year. Because the question I get is, well, how much do I have to take out at 72? If I don't need this money now, I'd much rather leave it in the account and let it grow tax deferred. But now the IRS is mandating me to take it out. You can see it, you can just take a look at this table. You look at the age 72, and the factor is 25.6. So what you do is you add up all of your pre-tax accounts, and as of 12/31 last year, and then divide it by the factor of 25.6, and that is the amount that you need to withdraw from any or all of your pre-tax accounts. It doesn't have to be any one in particular. If you want to take it out of this one instead of that one, that's perfectly fine. All it matters is that the IRS does collect their taxes when you withdraw these amounts. Many retirees also do conversions where they're converting IRA money to Roth IRA money. Keep in mind that conversions do not count towards the RMD. So if you are doing conversions and you're over age 72, you can do conversions, but you still have to take out the amount of the RMD first before you do your conversions. I will mention here that the RMDs, the required minimum distributions, apply for all pre-tax accounts and Roth 401ks. Even though Roth 401k is an after-tax account, because it's a group plan, it still falls under these rules. Pensions now. Oh, one last thing I wanted to mention about withdrawals is you do have to wait until you're 59 and a half before you start taking money out of any retirement account. Otherwise, you'll be hit with penalties and such. The one exception you have is if you have a 401k that you separated from service between the ages of 55 and 59 and a half. So there you have a small window to actually take money out of that 401k prior to age 59 and a half without paying a penalty. All right, moving on to pensions. Pensions, rare to find these days, to be honest, but they're typically employer funded and the investments are decided by the employer. So the key is the employer, your boss basically, has the ultimate control over the pension, how much they put into it, what kind of investments they are, how much you get out of it. You have no control over whether you have a pension or if it's good or how it works. It's rarely found in the private sector now, since companies are looking to shift that responsibility to employees. You can imagine as an employer, they don't want to be responsible for every employee's retirement. What if they make a bad investment decision and the employees aren't happy? Right, so it's rarely found in private sectors, and even in government jobs, you're starting to see that the calculations are not as good. If you terminate employment and you have a pension, you can choose whether you want to take that lump sum or wait until retirement age to claim the monthly benefits. You have that option. And then once you start the benefits, you cannot change them. So this is important. Make sure you discuss with like a CPA or a financial advisor how the benefits work before you elect them, because once you make that decision, you cannot undo it. We mentioned earlier that pensions are really all in the control of the employer. So guess what? If you are the employer, then this works in your favor. And we, financial advisors, we create retirement accounts all the time to set up your own private pension. And it works out really great if you have a business or a side income or a small business. If you're one of the lucky ones with a pension, how much you'll actually receive will be based on your employer's algorithm or equation, okay? So here's two sample calculations that I just pulled since most of us are in California. CalPERS is a pension for public employees. OSHA is a pension for Orange County employees. And you can see that it is some type of a calculation that involves years of service. There's some kind of a benefit factor. multiplied by your final compensation, and then there's a certain allowance, and then sometimes with that allowance, it gets modified. With OSHA, the language is something like 2.5% at age 55 or 1.62% at age 65. You can see the latter one is just not as favorable as that first one. And then the last thing I'll just mention is depending on when you actually left your employer, it might make sense to roll that lump sum into your own IRA or leave it there for income benefits at retirement. All right, Social Security. A lot of information today. So Social Security, you are only eligible for Social Security if you have 40 quarters of earnings. 40 quarters equals 10 years. It does not have to be consecutive. However, the income of Social Security income is based off of your highest 35 years of earnings. You can start Social Security income anywhere between age 62 and 70. It's important to know your full retirement age. So FRA is what you'll see it as. Full retirement age is when you will receive 100% of your benefits. If you start later, you'll get more. If you start earlier, you'll get less. And how much it increases or decreases depends on your age and actual birth month. For most people, full retirement age is at 66. Once you start receiving benefits, you are considered retired for Social Security purposes. If you continue to work while you're retired, then, and you can, and you're younger than your full retirement age, then your benefits will be reduced. Certain pensions will also work in coordination with, sometimes you'll see that, in coordination with or in conjunction with Social Security. What it means is it essentially just offsets your Social Security benefits when it comes time to take Social Security. What about some tax implications, Yuri?
Yeah, from a tax perspective, your retirement and pension distributions are generally taxed at your ordinary tax rate, unless you have post-tax retirement accounts like a Roth 401k or a Roth IRA. And up to 85% of your Social Security benefits could be taxable if you have like other sources of income. It's a common misconception that you're going to be in a lower tax rate when you retire, but you know that's not always the case. You might have a lot of retirement distributions, you know, you might have less deductions, you won't have any kids to claim, things like that. So your taxable income could end up being the same or even higher. So when it comes to these retirement distributions, you usually have the option to have taxes withheld from your payments, but it's not always enough to cover your tax liability. So when you are at that stage, when you're about to retire, it's a good idea to do some tax planning because retirement really drastically changes your tax situation. And you just want to make sure that you're not going to be hit with a big tax bill when you file your return.
And not only that, if you have to pay a lot every year by April, you end up getting penalized too. So if you want to avoid the penalty, it would be best to talk to your CPA and start paying quarterly estimated taxes.
Yes, that's right. A lot of people that do take retirement distributions do have to start making quarterly estimated tax payments to make sure they're on track. Because the IRS, you know, they don't want their money in April after the year's over. They want it throughout the year, and it's your responsibility to calculate your quarterly responsibility.
But it's okay for them to keep your taxes and not pay you interest and give you a refund, but not the other way around.
I mean, it's unbelievable how fast they are at cashing checks. But God forbid, you know, you're due a refund. I mean, you could wait forever sometimes.
One thing I will mention about what Yuri had mentioned is it surprises a lot of clients that they could potentially be in a higher tax bracket when they retire. When I talk to older clients, they all nod in agreement. They see it, they feel it, they know other people that are in a higher tax bracket when they retire. But when I talk to younger people, it just seems unfathomable because here they are making whatever their income is and they're paying all these taxes. And they just feel like, well, when I retire, I'm not making this income. So of course I'm not paying that much in taxes. But you forget that you're going to not only lose a lot of the deductions that you're given in your working years, you have children, you have 401k, you have potentially a mortgage write-off and such. Not only that, but your tax situation, you're starting to collect potentially pensions and 401ks. I had one client whose husband passed away. So she was collecting double. So she was collecting his pension on top of her pension. And then there was Social Security. And then, oh, there's also RMDs that you have to start taking out. So with all these mandatory distributions, it definitely pushed her in a higher tax bracket with no deductions. And that's assuming tax rates stay the same.
Yeah, we talked about this last time too, is that tax rates are really low right now. And by the time, we're at retirement age, they could be much higher. So yeah, that's where tax planning comes in, just to make sure that you're not only thinking about your taxes today, but you're thinking about them in the future as well. So if you're at that age when you're taking retirement distributions and Social Security and all that kind of stuff, you're also probably eligible for Medicare insurance. Donna, does Medicare typically cover most healthcare needs that we're going to have, when we're older, or should we consider additional coverage?
Oh, won't that be great? Won't that be great? The answer is it does not. However, one thing I will mention is if you delay your Social Security, remember how we talked about you can actually take your Social Security later after your full retirement age. If you decide to delay your Social Security, make sure you still sign up for Medicare at age 65. And the reason for that is because if you don't, your Medicare premiums might be increased and your coverage might be delayed. So even though they kind of go hand in hand a lot of times, make sure you sign up for Medicare at age 65, regardless of what you do with Social Security. Can we go to the next slide, please, Siri? All right. Medicare. So when people talk about Medicare, usually they're talking about Part A and Part B, because those are the two basic parts of Medicare. Part A is hospital bills. It is free. There is no premium associated with it as long as you have 40 quarters of earnings history. So that 40 quarters deja vu, we talked about that earlier with if you're eligible for Social Security. So if you're eligible for Social Security, then you get free Part A Medicare. And you don't have to pay it at all, and it covers hospital bills. Part B is doctor bills, and there is a premium associated with Part B, and it's based on your income. By default, it's automatically deducted from your Social Security, but let's say you haven't started Social Security yet, or maybe your Social Security is not enough to cover the premium, then they will just invoice you. Okay, we're going to talk a little bit more about Part B in a bit. Part C, Medicare Advantage, Medicare Supplements, Medigap, they're all kind of interchangeable names. The premium varies by plan and by income. And then lastly, Part D is for prescription drugs. The premium varies by plan and by income. So it's interesting to know, and we're going to go through this a little bit in the next few slides, how different parts of Medicare premium is based off of your income. Here is what Medicare does not cover. So most people only get A and B because that's the basic Medicare coverage. It does not cover prescription drugs. So you're going to have to purchase Part D if you want to cover prescription drugs. It does not cover long-term care. So your option is to either self-fund, which means you pay for it yourself, or you purchase long-term care insurance. So one of the two options. Most people, what I usually tell people is really wealthy people and really poor people don't need long-term care insurance because they're covered either way, right? If you have a lot of wealth, you can pay for it out of pocket. If you don't, then Medicaid will cover part of it. Okay, but everyone else in the middle, they're probably looking at some kind of long-term care coverage. Otherwise, you're just going to have to self-fund it. Deductibles and copays, dental care, vision care, hearing aids, all of those are not covered by Medicare. You're going to have to pay for that with your savings, out-of-pocket savings, or if you had an HSA account, health savings account during your working years, if you have that, if there's still leftover money in that account, you can use that account to pay deductible copays, dental, vision, hearing aids, and such. And some Medicare Advantage plans, Part C, Medicare Part C, will cover those as well. Medicare, medical care overseas. So a lot of people, when they're working, they like to vacation and travel. Medicare will not cover overseas healthcare. So make sure you purchase travel insurance or purchase some type of a Medigap policy to cover that. Let's talk a little bit more about Part B and how the premium is determined by your income. This is usually a shocker for most people. So if, first of all, the premiums that you pay this year is not based off of what your income is this year, rather it's based off of it 2 years ago, okay? So if your yearly income in 2018 is this is what you pay in 2020. So what you're paying now is based off of what your tax return looked like in 2018. So the least it would be is at $144.60 a month. And that only applies if you're, let's just go with a single tax return, individual tax return. If your income is $87,000 or less, okay? If your income is, let's say, $120,000, you jump to that third bracket, right? And your premium that you would have to pay is $289.20 per month. So you can see that the increases go up just a little bit at a time, and then it just increases faster and faster. Okay, so this becomes important because you have to know how much, if you're going to be converting anything from IRA to Roth IRAs, as a lot of retirees do. Next slide, Part D. All right, so this basically is the same thing, but just for Part D premiums for prescription care. I know there's a lot of information in these slides, and it's tempting to print screen, but these slides, this presentation will be recorded and made available afterwards.
That's a lot of really good information on Medicare and Social Security. I remember when my mom was eligible for Social Security and Medicare, and I actually didn't know that you didn't have to do both at the same time. But I remember trying to help her sort it all out, and it was like very overwhelming. I kind of wish I knew you back then. So in addition to Medicare and health insurance, there are other things to consider when caring for our aging parents. Sophia, what should we be planning for from like a legal and estate planning perspective?
Yeah, I'm glad you asked that. And, you know, the question I always get is, how can I help my parents who maybe need assistance, whether it be a physical disability or maybe a mental disability? So that's kind of what I wanted to focus on, is a physical incapacity. Maybe they're disabled, they're in a wheelchair, they can't walk, maybe they have vision issues. Well, they need your help, and the way that you can help them from a legal standpoint is to have something called an Advanced Healthcare Directive in place. What that is, it's a form that before your parents get sick, before, you know, the best thing is to do when they're, you know, fine, what they do is designate an agent who can make health decisions for them when they're not able to communicate with the doctor regarding their health decisions. So here, you know, parent would probably name a child or someone else, or maybe a spouse, someone else to be an agent to talk with the doctors. They can get the medical records, make decisions on their behalf. This Advanced Healthcare Directive also sets a priority order about who can make those decisions. So if the whole family is disagreeing about what to do, the person in the number one spot will have the final say. If you do not have this directive, then, you know, the doctors are like, well, who's going to make this decision? Like and maybe they won't even release that information because of the HIPAA laws are so strict. So having that document in place is going to be very important, taking them to the doctor, helping them with their medication. If you don't have that and they're already in a situation where they cannot communicate with the doctor, you might have to ask the court to appoint you to act and make decisions on their behalf. And that is the conservatorship court process. And it's the conservatorship over the person. Compare that with the mental incapacity. So this is like, maybe you're physically fine, but maybe you have dementia, maybe you're in a coma, you're in a situation where you do not know what you're signing, you don't know, you know, you do not have the legal capacity to sign contracts, to make a will, to make a trust. Hopefully before you get to that stage, you would have prepared something called a power of attorney. A power of attorney form is when you are alive, but maybe you're mentally incapacitated. And this also designates an agent, also known as an attorney, in fact, to sign the checks for you, go to the bank, manage your finances, maybe even sign your name on a deed, and do all these financial things for you when you're not able to do that. It's also really important because this power of attorney will also say when someone is determined incapacitated. Sometimes in my forms, I say 2 doctors have to say that the person is no longer has the mental capacity. If it doesn't say anything about that, then who's going to know? Who's going to make that decision? And if you don't write it down, then usually the courts will have to make that determination. And that could also be a conservatorship court process. Now, anytime you go to court, you know, it's going to take a long time. It's going to be really expensive. It's very stressful. And maybe sometimes decisions need to be made right away. So having these powers in place before you're in it, before you're in that situation is going to be so important. And of course, a trustee. So a trustee is the manager or someone that takes care of trust assets. And whether you're physically incapacitated or mentally incapacitated, if you do have assets in a trust, a living trust, then the trustee will be able to manage that for you. I also want to talk about physical incapacity a little bit. I forgot to mention that if your parents are needing help, you know, with getting around, if they're low income, you may apply for something called IHSS through Medi-Cal. Medi-Cal is through the state. Medicare is through the federal. So if you do have low income, there could be sources to help you pay for caregivers to come to the home. Medicare might also have that program also. It depends on the type of program that you have. Let me see. But Donna, I've been talking about the legal side. What advice do you usually give your clients from a financial perspective?
Well, all the ones that you have mentioned, like power of attorneys, medical directives, trusts and such, those are definitely the best option. It's the cleanest and the most comprehensive options. So whatever you have set up with your attorney, make sure you let your financial advisor know. However, a couple things to note is that many brokerage firms do allow for you to name a trusted contact person on the account. This is account specific. It is not the same as a power of attorney. The trusted contact person does not have authority to transact business, make any decisions on your account. They're only consulted in cases when the advisor is having difficulty reaching the client or communicating with the client, or believe that the client may be a victim of fraud or exploitation of some sort. Sometimes you can also have the option to add a third-party authorization on file. This would apply not necessarily to a specific account, but it can apply to you as a person. So it allows advisors to disclose account-related information to a third party. Third-party authorizations still do not have the authority to make any decisions on the account, but the info can just be disclosed to them. Commonly, we see this used with business accounts where the CPA is asking for certain tax documents and we can send it directly to the CPA. But we have also seen this used for, I want to make sure that my daughter or my grandchild or my son or daughter is included in all communications. So it's something to see what kind of options your advisor provides.
Okay, so switching gears a little bit, this is a question I get a lot, but Sophia, maybe you can answer this. When someone receives a gift or inheritance, do they have to pay tax on it?
Yeah, Yuri, I get that question quite often. So I'll talk from the perspective of someone receiving the gift, like a beneficiary or like the children, the heirs. Generally, the short answer is no. When they do receive an inheritance, they don't have to pay taxes on it. There is something that I want to point out, which is a lifetime gift, which is gifts that are made or received during the lifetime, and then inheritance, which is gifts made after death. So sometimes I tell my clients and they're the parents, and they're thinking, well, should I give my assets like now or later? And you know, sometimes I tell them, hey, if you want to, there's like that emotional value when you give them a gift, and then you can see, oh, they're putting it to good use, you know, and you know, you're giving it to the loved ones, and there's that benefit, which is huge as well. When you do give gifts during your lifetime, you don't pay taxes. The recipient doesn't pay taxes, but there is some other type of things to consider, other type of consequential, like capital gains taxes and other things to think about. Inheritance is after death. So maybe you wrote it in your will, maybe you wrote it in your trust, maybe you have a beneficiary after death. That's usually when the inheritance will come to you. Generally, no taxes on that. But like I said before, there could be some other consequences in terms of maybe you received an income generating property. So obviously it's going to generate income. You're probably going to have to pay some taxes on that. Maybe you received some real estate. There could be a property tax reassessment. So be sure to file the proper forms with the county assessor to maybe not have that reassessment. And one thing I did want to note about inheritance is if you are married and you get an inheritance, typically that comes to you as separate property. If you do want to keep it as separate, you need to do you need to write it down and make sure the proper steps are made so that this inheritance will be your separate property. Otherwise, it could be transmuted or changed to community property. So you just want to be aware of that. Yuri, from a tax standpoint, what happens to the tax basis upon these gifts in terms of capital gains tax?
So I'll talk about that in a minute. Real quick, just adding on to the whole like gift tax thing. The annual gift tax exclusion is right now it's $15,000 a person. So I can gift you $15,000 and my husband could gift you $15,000 for a total of $30,000 and there's no reporting required. But if the amount of the gift is more than $15,000, then I, as the gift giver, have to report it on a gift tax return. If the gift isn't cash, it's equity in a house or it's stocks or something like that, then the value of the gift for this purpose is the fair market value of the asset on the date of the gift. There is a lifetime gift limit, which is around $11.5 million. But yeah, I get that question a lot. My parents want to give me their house. What's the best way to do it? Am I going to have to pay taxes? Who pays the capital gains? As the laws are right now for income tax purposes, which includes capital gains tax, it's usually better to inherit a property, which is, inheriting a property upon someone's death, rather than receiving it as a gift during their lifetime. And the main reason for this is the step up in basis on inherited assets. Basis is generally your investment in a property, and it's the number used to calculate your taxable gain or loss when you sell a property. For this purpose, it's usually a taxable gain, which is taxed at your capital gains tax rate. So just a quick example, mom owns a house, she passes away, her daughter's the beneficiary and she inherits it. Mom bought the house a long time ago for $100,000 and it's worth $300,000 when she dies. When daughter inherits the house, her basis is the value of the house on the date of death, which is $300,000. So she could turn around and sell it for $300,000 and there's no tax to pay. Let's say, I'm sorry.
Oh, I'm sorry. I was just going to say, in your example, then, if she had that 100,000 and then mom gave it to her during their lifetime, and now it's 300 when mom passes, what would the daughter have to pay?
Yeah, so if she gifts it during her lifetime, daughter's going to have to pay tax on $200,000 of gain. The difference between the $100,000 her mom purchased it for and the $300,000 sales tax or a sales price. And I mean, that's just a huge difference. And this is not going to be the same for everyone, but it just goes to show before you start just transferring out assets to all your kids, just, maybe you just want to get stuff out of your name, just, to simplify your life. There are things to consider, and it's a really good idea to talk to your accountant, talk to your attorney, talk to your financial advisor, because we're all going to have different perspectives on this. And we'll all, hopefully we can all work together to come up with a plan that's best for you. Because the last thing you want to do is pay a lot of taxes on these things that you intend to leave to your kids. These are assets you worked your whole life for. So whatever, if there's a better way to do it to save taxes or whatever, planning would really help you minimize that. So, there's also property taxes. That's a big thing too. Sophia, can you talk about how this affects property tax.
Yeah, because when people, when parents transfer houses or real estate to their kids, sometimes they don't think about property tax reassessment. And it's going to be really important if the child wants to keep that property. You know, maybe parents bought it a long time ago. Well, there's something called Prop 13 where the annual property taxes do not increase very much. And so if they had a property from a long time ago, probably their property taxes are really low. If you do give it to a child, you fall under an exclusion where your property taxes to the county do not get reassessed for the date of the change of ownership. So here, when you give an asset from parent to child, you have to let the assessor know, hey, it's from a parent to child, and then they can exclude it, because anytime there is a deed or a change of ownership, the county always wants to reassess it unless it falls under an exclusion. So, but keep in mind, there is a time limit to file that form with the assessor, 3 years. If you do, like I had a client whose parents passed away like 20 years ago or something, and they never like did anything with the deed. So they probably do have some property taxes to pay. But once you file that form with the assessor, then it would go right back down to whatever the parents were paying. But there could be some other taxes that you have to pay on that. In addition to property taxes, something else to consider when transferring title from parent to child is like now the child is technically the owner of this asset. So I'm sure this won't happen, but as an attorney, of course, I've seen it all, where now child needs that house. They need to sell it. They need the money, you know, and it's technically theirs. Or maybe they need to refinance it. They need to put like, you know, a lien on it, get some money out of it. It's theirs. They can do that. So we do want to make sure about that. And there's also that liability, of course, now the child is the owner on that property. If they get in a car accident, hey, that's part of their assets. It could be, you know, subject to a lawsuit, you know, so there's other things to think about. Next slide. Okay, so the question is, well, what happens if there is no estate plan, right? So having no estate plan is still a plan. It's not really a good one, but hey, the California default laws are in place to handle such situations. Of course, that default would be either a conservatorship court process, like I mentioned before, or probate. And in California, if you do have assets that are just in your name and they don't have a beneficiary, they're not held in joint or anything like that, if it's over $166,000, it does have to go through probate court. Sometimes life insurance would be a good strategy. If you have like a mortgage on a property, if you have some life insurance, there's some cash that's brought into the estate that can pay some medical expenses, pay off the mortgage, so that when the kids get the property as an inheritance, they'll be able to get that free of mortgage. Otherwise, if the kids can't pay off the mortgage, they'll have to sell the property. All right, so the last slide. Oh, Donna, did you want to say anything about life insurance?
Well, I've seen cases before where the parents pass away, there's a good amount of wealth there, but the problem is everything is tied up in real estate or land and it's not liquid, but there's still bills that need to be paid. So instead of going through a fire sale, it's just easier to have liquid assets in a life insurance plan.
Oh, yes, that's a really good point. And actually something that my clients always do is even though they have a trust, they want to name their like 2 kids as beneficiaries of a life insurance. That's fine. I tell them, yeah, it'll go to them. It'll avoid probate. But keep in mind when the life insurance goes to the beneficiary, it doesn't go into your trust. It goes directly to them. It's their money now. And what if they don't want to use it on, you know, things for parents' expenses, medical bills? They don't have to. It's technically their money. So sometimes in that case, I say, the beneficiary of a life insurance could be your trust. The money goes right into the trust. It's for your kids anyway, but now there's some obligation for the trustee to use it for the trust benefit. All right, so next steps, you know, thank you for joining us with this 4-part series. As you can tell, we've been talking about protecting your assets and kind of planning for the future. One of the very fundamental things about, or the foundation of, you know, taxes, financial advice is having a good estate plan. Maybe it's having a living trust because you've worked so hard Having that trust and these documents in place are going to be so important. So of course, if you do have a living trust, review it, make sure it's still what you want it to be. If you don't, set up a consultation or learn more about setting one up. Ensure your assets are titled correctly. Is the deed correct? One time I had a client and they forgot they had put uncle and aunt on the deed, and they had forgot they had done that. So that needs to be redone. And of course, retirement planning, tax planning, you've seen the charts, you've heard Donna speak, and taxes the rates could change in the future. So that planning is going to be so important. Donna, anything else to add?
No, and I don't think we have any time for questions. This one was a lot of information packed in a very short amount of time. So I want to thank everybody for your time. As usual, we really strive to provide content that's worthy of your time. And we hope that you have found this series to be useful. Many of you guys have already reached out to us with additional questions, and we love that. We do these presentations because we want to educate and provide you with resources. We know that life happens, and we want you to know who you can turn to when these questions come up. Our next event will be on year-end planning. It'll be on Friday, November 20th at noon. We will still have the three of us as panelists, and we will be discussing some things you should consider as the end of the year is quickly approaching. We post all our events on Facebook, on our website. So as usual, please feel free to invite your friends to join us. We will be sending out a survey shortly. So please respond and let us know what improvements we can make. We hope everyone stays safe and healthy. Have a great weekend.
Thanks, everyone.
Thank you.